Foreign exchange reserves are a country's stockpile of foreign currency assets, such as United States dollars, euros, and yen. They are held by central banks and other monetary authorities to meet a variety of needs, such as to pay for imports, to stabilize the value of the country's currency, to provide a cushion against financial crises. Foreign exchange reserves are important because they help to ensure that a country has the resources it needs to meet its international obligations. They also help to stabilize the country's currency and prevent financial crises. In the next few minutes, I'll tell you more about how foreign exchange reserves work, how they are used, and why they are important. First of all, we discuss different components of foreign exchange reserves. Foreign currency assets. These are the most common component of foreign exchange reserves and consist of deposits, bonds, and other securities denominated in foreign currencies. The most common currencies held as foreign currency assets are the United States dollar, euro, and yen. Gold reserves. Gold has traditionally been seen as a safe haven asset and is still held by many central banks. However, the importance of gold reserves has declined in recent years as central banks have shifted their focus to holding more foreign currency assets. Special drawing rights. SDRs are an international reserve asset created by the International Monetary Fund, IMF. They are not a physical asset like gold or foreign currency, but rather a claim on the IMF. SDRs can be used by IMF members to settle international transactions or to supplement their foreign exchange reserves. The composition of foreign exchange reserves varies from country to country. Some countries, such as China, hold a large amount of gold reserves. Other countries, such as Japan, hold a large amount of United States dollar assets. The composition of foreign exchange reserves is also influenced by factors such as the country's trade balance, capital flows, and economic growth. Here are some of the reasons why countries hold foreign exchange reserves. To pay for imports. Foreign exchange reserves can be used to pay for imports of goods and services. This is especially important for countries that import a lot of goods and services. To stabilize the value of the country's currency. Foreign exchange reserves can be used to buy the country's currency and prop up its value. This can help to prevent inflation and keep the economy stable. To provide a cushion against financial crises. Foreign exchange reserves can be used to bail out banks or other financial institutions during a financial crisis. This can help to prevent the crisis from spreading and causing more damage to the economy. Here are some of the ways that central banks use foreign exchange reserves to manage their country's economies. Buying and selling currencies. Central banks can buy and sell currencies in the foreign exchange market to influence the value of their own currency. For example, if a central bank wants to weaken its currency, it can sell that currency in the market. This will increase the supply of the currency and lower its value. Intervening in currency markets. Central banks can also intervene directly in the currency markets by buying or selling currencies. This is a more forceful measure than simply buying and selling currencies, and it is usually used in times of crisis. Setting interest rates. Central banks can also use interest rates to influence the value of their currency. When interest rates are high, it makes it more attractive for investors to hold that currency, which can help to strengthen its value. Influencing capital flows. Central banks can also influence capital flows by buying and selling government bonds and other assets. When a central bank buys government bonds, it injects money into the economy, which can help to strengthen the currency. Now we discuss some of the factors that can affect the size and composition of foreign exchange reserves. Trade balance. The trade balance is the difference between the value of a country's exports and imports. A country with a trade surplus will have more foreign exchange reserves than a country with a trade deficit. This is because the country with the trade surplus will be receiving more foreign currency than it is spending. Capital flows. Capital flows are the movement of money between countries. When a country experiences a large inflow of capital, it will have more foreign exchange reserves. This is because the foreign investors will be bringing their money into the country in the form of foreign currency. Economic growth. Economic growth can also affect the size of foreign exchange reserves. When a country is growing rapidly, it will need more foreign currency to pay for imports of goods and services. This can lead to an increase in the size of the country's foreign exchange reserves. Exchange rate regime. The exchange rate regime is the system that a country uses to determine the value of its currency. Countries with fixed exchange rate regimes tend to hold larger foreign exchange reserves than countries with floating exchange rate regimes. This is because countries with fixed exchange rate regimes need to have enough foreign currency reserves to intervene in the currency markets if the value of their currency starts to fall. Monetary policy. Monetary policy is the set of actions that a central bank takes to influence the money supply and interest rates in an economy. Countries with more expansionary monetary policies tend to hold larger foreign exchange reserves. This is because expansionary monetary policies can lead to higher inflation, which can make a country's currency less attractive to investors. Political stability. Political stability can also affect the size of foreign exchange reserves. Countries with political instability tend to hold larger foreign exchange reserves. This is because investors are more likely to invest in countries with political stability, which can lead to an increase in the demand for the country's currency. Here are some examples of countries with high and low foreign exchange reserves. Countries with high foreign exchange reserves as of June 30, 2023. China stands at number 1 with $3.4 trillion. At second position there stands Japan with $1.2 trillion. And Switzerland holds third position with $948.7 billion foreign exchange reserves. Now names of countries with low foreign exchange reserves. Dominica has $190.8 million, Burundi has $266.2 million and Samoa has $294.7 million foreign exchange reserves. The size of a country's foreign exchange reserves can be used as a measure of its economic strength. However, it is important to remember that other factors, such as the trade balance, capital flows, and economic growth, are also important. Countries with high foreign exchange reserves may be more resilient to economic shocks, such as a sudden decline in exports or a financial crisis. However, countries with low foreign exchange reserves may be more vulnerable to these shocks. Countries with high foreign exchange reserves may also be more likely to intervene in the foreign exchange market to influence the value of their currency. This can be done to stabilize the currency or to prevent it from depreciating too much. Now we see some of the implications of low foreign exchange reserves for a country's economy. Increased vulnerability to economic shocks. Countries with low foreign exchange reserves are more vulnerable to economic shocks, such as a sudden decline in exports or a financial crisis. This is because they have fewer resources to use to stabilize their economy. Increased risk of currency depreciation. When a country has low foreign exchange reserves, it may be forced to sell its currency to pay for imports. This can lead to a depreciation of the currency, which can make it more expensive for businesses to import goods and services. This can lead to inflation and economic problems. Reduced ability to intervene in the foreign exchange market. Countries with low foreign exchange reserves are less able to intervene in the foreign exchange market to influence the value of their currency. This can make it more difficult to stabilize the currency and prevent it from depreciating too much. Increased risk of default on debt obligations. Countries with low foreign exchange reserves may be more likely to default on their debt obligations. This is because they may not have enough foreign currency to repay their debts. Reduced confidence in the economy. Low foreign exchange reserves can reduce confidence in the economy. This can make it more difficult for businesses to invest and grow, which can lead to economic problems. It is important to note that the countries with low foreign exchange reserves are more vulnerable to economic shocks and are less able to manage their economies effectively.